I started giving this talk however many years back because Pittsburgh, it's not easy raising money, but we have a wealth of resources for very early stage funding, either through Carnegie Mellon, Alpha Lab, Innovation Works, Blue Tree Angels, some of the other local angel groups. But then there's, you could raise 250, $500,000, maybe $1 million. But then there's a little bit of a trough in that, $1 to $10 million raise before you're bringing in big institutional funds from outside of the city. So for years, I had heard, there's this funding trough. Where can I find follow-on capital? And then the other question I heard all the time was, hey, I'm a non-technical student, person, professional. I would like to get involved with startups, but I don't code. I don't know CS. What can I do that would be helpful as a real team member of a startup? Not all companies need to raise capital. In fact, some companies, it's really not appropriate for their business model to raise capital. Flip side of that, some companies, very much given their competitive environment and the investment it takes to scale, are very well suited and probably should raise capital. So of those, which tend to be, the techier types of hardware also that come out of this university, all companies can always be networking to find additional sources of capital, and you should always be doing it before you need it. So what we're going to talk about today is how to prepare to find follow-on capital, what are some of the pitfalls, and what are the resources available to students at Carnegie Mellon that all Carnegie Mellon startups, all startups in Pittsburgh could use and would be incredibly valuable. I am the vice president at 7 Mile Advisors. We're a mid-market investment bank. We primarily deal with tech and services companies. We've done half a dozen deals here in Pittsburgh. We're international. More than a quarter, less than half of our deals are cross-border each year. We do about 35 transactions, mostly M&A. We do some capital raise, but it's primarily mergers and acquisitions in the 25 to 250 million EV range. We'll do a couple above that each year, but that's generally our sweet spot. Representing founders, family management business owners, selling 50-50 into strategics versus financial investors, mostly private equity funds. Prior to 7 Mile, I ran corp dev for MedExpress Urgent Care and worked at healthcare M&A across the portfolio for Optum and United Health Group. And before that, I was with a private equity firm, mostly doing heavy industrials, but we also had a tech portfolio centered on industrial automation and robotics. Originally a Pittsburgh guy, Carnegie Mellon alum. Go Scotties. Happy to pay it forward. So anyone who's done fundraising has heard this line before. Sometimes it's sincere and sometimes it's a polite no thank you. So what we're going to cover today is going to decrease the number of times that you're likely to hear this. And then what do you do when you actually hear this? Also, touch on a little bit why, do people hire investment bankers? I used to start this talk by poking fun at investment bankers and how a group of bright Carnegie Mellon students could do the same work. I still start the talk that way. So we have some bright Carnegie Mellon students that can do most of the work of a lot of investment bankers, but the good ones, why do people hire them? And what can you do for a startup? If you leave today with nothing else, I'll call out, there's a couple slides you should take pictures of or write down in your notes specifically. Ryan Splenda in the library, write down his name and his email. He can show you how to use all of these databases that we're going to talk about. He's happy to do it. When I was a student, I did not know that there was such a thing as a business librarian. He's amazing. He's like Superman. It's almost like having a cheat code. He's so helpful. It feels unfair, but it's not. That's just what he does. He's here to help. So what are some of the resources that we're going to talk about today? So as students at Carnegie Mellon, you have paid for access to these databases. which amount to hundreds of thousands of dollars of subscriptions. So when you are no longer a student, it would take hundreds of thousands of dollars to purchase the access to the databases that you have. So you're already paying for them. Let's learn how to use them a little bit. Most of these databases that provide information on money that companies have raised and who they raised it from and who those investors, co-investors are and what they'd like to invest in, their profiles and amount of activity and how much dry powder they have to invest out of. Most of that information is duplicative amongst these resources, but not all. I'd say there's maybe 75% overlap. So in any search where you're looking for investors and you're doing research, I would encourage you to use more than one because it's not complete overlap. They have different quality of information, but they generally source it from the same places. MarketLine is one of my favorites, and we'll touch on them. There's a little bit of a helpful cheat that they have. S&P Cap IQ, I would say, is the most comprehensive, but it also has the worst UI. It hasn't been updated in at least 20 years that I've been using it, but a very good product. And CB Insights, Crunchbase, Hoovers, those are good at the top of the funnel where you're doing a little ideation. You're just trying to get a sense of the landscape, as opposed to drilling down into deep detail like you would do in Cap IQ. And then other general resources that are available and fairly cheap. A lot of these databases are expensive, but fairly cheap. AngelList Pro, Crunchbase Pro, and locally the Pittsburgh Business Times. Excellent resource. So not to be overlooked. And then finally, the SEC filings that we'll touch on a little bit for doing a little extra digging. So we're going to look at a couple companies that have come out of Carnegie Mellon just to give you a sense of what information is available. This whole process can be done by any undergrad with little or no business experience. The process is very much like going down a Wikipedia rabbit hole. You iterate. You dig, you're going to find leads, you're going to follow those leads. Those are going to lead to a new web of other connections to new investors with new profiles, new companies that have different sets of investors. And you rinse, wash, and repeat. Change your criteria, search again. It takes time. That's like the main constraint here. So if you're a founder and you're working on building a technology, building a team, running a company, this is time intensive. And that's one of the reasons why it's so helpful to have a student resource or another person on the team who's at least partially, focused 100% on building out the investor database and getting ready to go to market and do a solicitation. Find the follow on funding. So we're going to touch on a couple companies to give you some examples as to what you find here, and then what you need to track and how to get prepared to approach the investors that you find. Here we go. So Solvi, CMU company, raised $50K out of the Open Field Entrepreneurs Fund. So one of the accessible early funding sources that we have here. This gentleman and this gentleman are the two CMU students. What Solvi does is it's automation for customer service chatbots. So you can see on the left, they do a little bit of natural language processing. That's a little novel, but the real special sauce is their ability to kind of mine the knowledge base and actually come up with answers to questions that people have asked. So raised $50K, and then Carnegie Mellon, out of the endowment, along with some other investors, participated in a seed round 2 years later at $4.5 million. And boop, then their logo changed. It's now from Zoom, and they exited last year for $121 million. So let's look at Solvi. I think it's a nice recent Carnegie Mellon example here. What you're looking at now is the info that would come out of Cap IQ. You say, hey, Carnegie Mellon came in on a seed round I have a company that's going into McGinnis, then hopefully I'll get to Open Field, maybe Project Olympus, maybe we'll do Alpha Lab. But what about that first seed round? Who came in on that? Well, here you're able to see the co-investors that came in with Carnegie Mellon. True Ventures is a name that will come up over and over again. You're also able to see all of the company's funding history. So after the $500,000 pre-seed and then their seed, they did a $17 million round, followed by another 3. And then this is the list of the lead investors down below from all of those investment firms. So something that we're going to talk about is that investment firms don't make investments, investors make investments. So you can have a name of a firm, but you still need to know the person to talk to. Pretty interesting. Not always available, but because Zoom's a public company, it's in the disclosures. You can also see some of the terms of their raise. So they offered a 1x liquidation preference. Terms matter. Headline numbers are sexy, but terms matter just as much. And can make a big difference between what's an attractive offer and what's not. So they have a 1x liquidation preference. So if you're in a negotiation with an investor and they say, oh no, everyone gets 2x liquidation preferences, which means they get to take their money off the top before anyone else gets any returns distributed. Here's one example you can point to say, hey, I think 1x. A lot of the work that we're going to do here today is one step short of putting together a comparable transactions table. It's called a comp table. Any investor you talk to is going to have a comp table of other transactions that they're going to reference to say, hey, this is the market price. You should go in and be equally prepared. After LinkedIn IPO'd, I can't tell you the number of companies that had LinkedIn as a comp for how they should be valued. It could be a toilet cleaning company and they're like, oh, we're just like LinkedIn. We should be at 40 times revenue. So all this work goes very easily into the information that you'll need to negotiate with the investors once you track them down. You can also see that the liquidation preference is non-participating, which is a little detail just to make a note of. Other Pittsburgh companies here, InvestEdge, financial management software. Look up their profile. You can see here, Randy was their lender. So equity is expensive. Sometimes some companies are eligible for debt financing that can be preferable. So it's not always that you're tracking down equity financing. Debt's also attractive. And the lenders work very closely with the equity investors. So if you can't get straight to the equity investor, maybe track down Randy. But Featherlink Capital, all right. So Featherlink Capital, they led the deal. Looks like Elizabeth Farrow was the lead on it. Here's a sign of a good investor. What you want to see is that they're very open about what they're looking for. Investors are deluged with requests, especially the good ones. And they're trying to sort through what fits their profile. That means when you approach an investor, it's incumbent upon you to show that you've at least looked at their profile. You've ascertained for yourself that you're a match, at least at the surface level. And it's important that you convey that to them. Say, hey, I took the time to read through your selection criteria, the industries you focus on, and the traits that are important to you. My company matches those, and that's why you should look at us. So Liz here lays that all very nicely out in plain English right on our website, along with our contact information. So as we're finding investors who have invested in companies like yours, you should be able to find this type of information, take note of it. We'll hit on an example that's not quite in that same vein. Industry weapon, similarly, looking through the list of investors, I'm sure the guys in the back know Ed Engler, Pittsburgh Equity Partners, now Three Rivers Rising, big fan of Ed, incredible investor. I believe there's actually a conference room back here named after Ed. So for all the students, when you're thinking, all right, so I'm starting to find some names that I think are applicable, but where do I start and who can I get a hold of? How do I get an introduction? Well, at least in this example, Ed's a good place to start, and anyone in this Swartz Center can introduce you to Ed. I think he actually holds office hours here once a week. Other CMU examples here covering life sciences. So, it separates by industry. Co-pilots, a fun one. They were a McGinnis competition company. I saw them in their first year when these were, I believe, undergrad juniors who had put the company together. And then after McGinnis, last year, they raised a almost $6 million Series A, which I found on Twitter who the lead investment was, or who the lead investor behind the investment was. So I point that out to say, like, all resources are at your disposal. You have to do some digging. It was not disclosed that Allison was the lead partner on the deal. And to my note before, investors make deals, investment firms don't make deals. So again, back to the Wikipedia rabbit hole, you're using all resources available, but you need to start somewhere, and you're looking for leads. Over the years, the font on this page has gotten smaller and smaller. Carnegie Mellon has at least 92 co-investors on the companies they've invested in. I expect the real number is probably 3 times that, but say 2 years ago, this number was maybe half. So it's been growing exponentially. We're going to talk about the hierarchy of introductions, but an introduction from a co-investor is about as valuable as it gets. So again, you're a Carnegie Mellon student, you may be a Swartz fellow, you're certainly here in this room today. Any of these investment firms, if you're looking for an introduction, you already have the resources to have that introduction made, and that's a great place to start. So congratulations, you got into Carnegie Mellon. You're part of an exclusive club that works with all these top-notch investment firms that are looking for companies like the ones you may be working with. So what are the steps that we're going to go through today? Well, when you're looking for investors who might cut you a check, it's good to see what they've invested in. And investors typically have themes, and they always have criteria. So a good place to start is finding companies that are comparable to yours and who invested in those companies, and who are those investors, co-investors. Then we got to reach out and make contact. And then what do you have to do to be prepared to make contact? The first step in identifying comparable companies is stop, pause, and do a little bit of self-reflection. You have to profile your own company first before you can figure out what's a comparable company to yours. Maybe not surprisingly, that's a step a lot of people seem to gloss over. So I do want to highlight, a little knowledge of self goes a long way. In defining your company in terms that will be applicable to the investors that you approach, think about the industry that you're in. Start broad, you may narrow. I don't think people would have always considered, the bicycle a competitor to a horse or an automobile, but generally speaking, think that's an example of thinking broad about your sector. Target market. So a lot of investors like companies that, hey, we have experience selling into their end customers. We can make introductions. We can work with them on sales strategy. So we have experience, and that's what you're looking for, selling into your end markets. So who is it that you're serving within that industry? Your company's stage. Do you have revenue? Are you pre-revenue? You have revenue, but no earnings. Are you looking for investment to really help build up the technology or build up the sales team? So what stage are you? The investment size. Investment size is important. Most investors are investing out of a static fund. They have a set pool of money. They have to diversify their investments. So typically think 20 investments ballpark per fund, depending on how active the investor is. So the size of the fund divided by 20, divided by 2 or 3, they should be holding back some money for follow-on investments. It's going to determine how much their initial check can be. So investors that tend to write $3 million checks are very unlikely to write a $10 or $20 million check, and vice versa. So how much are you going out for? And then you have to find investors that cut checks that fit in that range. And these are the general ranges you should think about. On that, I would also add, however much money you think you need to raise, probably double it. And then geography, which is becoming less relevant, but there still are many investors that like to at least be able to get on a plane without making a connection to come spend some face time with their companies every once in a while. So step one, profile your company in these terms. These are also going to be the search terms that you'll use in the databases. And then that's our start to go find comparable companies and see who invested in them. CB Insights is a great place to get started. They have these pre-made market maps for a bunch of industries. And this is like, you're still ideating, you're just getting your sea legs under you, looking around for, hey, what types of, if I'm thinking broad, what types of comparable companies and what are some examples? So I recommend starting at CB Insights, and they cover everything from payments, life science services, renewable energy. And I get a little kick out of how granular they can get. This is applicable for you, Poop Tech right here. So, that might be a good map for you to start with, investors who are investing there, or maybe, down below robotics and robotics process automation. And then they have sub maps within each one of those industries as you get more granular as to what's your sub segment. So in online fashion, as an example, you can see how they break out the different sectors and examples of companies that have received venture funding in each one. So again, we're at the beginning stage, identifying comparable companies. When you look through CB for investors, you're going to use a series of filters. This is the way all these databases work. And again, they're not perfect. But here you're looking for, hey, sticking with the online fashion example, they have 805 investors in their database who are making venture investments across the spectrum in online fashion. You find upfront ventures, you pick them. Hey, they've made, I think you can see on the prior slide, they've made 8 investments out of their current fund. 4 of them are broadly in online fashion, although if they're an investor in 500 startups, that's another investment firm. So I'd really say it's probably 3 out of 7 or 8. And then you can see, okay, of those portfolio companies listed, who are the most active investors, and how often do they show up, and what have they invested in? So again, you see up front here, there's 7 portfolio companies listed right in the middle. We just saw on the prior slide, half of those are in online fashion. And these are the firms that they most often co-invest with. And you can see how many portfolio companies they have and who they are in the online fashion category. So you're starting to see how this is iterative, but you're getting leads on it. Hey, who are the active investors and what have they invested in? And are those companies like my company? One of the investors listed is Break Trail Ventures. Columbus isn't too far away. But you heard earlier when I was talking about Liz Farrow, who was very candid and transparent about what she was looking for and how to get a hold of her. Break Trail, you would be hard pressed to find out who actually is Break Trail. They have contact, they have about with no information, listed. They invested in a company locally, came out of Carnegie Mellon. Sophia Berman, fantastic entrepreneur, big fan. But man, shadowy investors that don't tell you who they are. I learned from a smart guy in the back of this room a long time ago. That's not always a good sign. You might want to be a little wary of it. Investors are trying to attract companies. It's in their best interest. just like our friends in the back here who said, hey, we're open for business. We have money to invest. This is what we invest in. Come approach us. Give us the pitch. So, why would you hide who you are? You have some tools to figure that out, though. This comes off of the SEC Edgar filing website. Everyone has access to this. Just Google it. You can put in any company that's raised capital. There's mandatory filings. They're not always made, but they are mandatory. And you can see that Sophia raised $2 million. At the time that I pulled this, she was at $1,450,000 on her $2 million raise. And the address of Jay Hirsch matches that of Break Trail Ventures, which you can then go look up and see that Jay is investing out of a $20 million fund that he had set up to raise. So Jay, your name's out here on the investments you're making. I don't know why you're not a little more upfront on your website, but that's how you find out who Break Trail Ventures is, or any investment firm, or the partners or the capital providers are trying to remain a little anonymous. Complete opposite end of the spectrum. Henry here puts all of this even on his LinkedIn profile and says, hey, if you match any of these, and they focus specifically on minority-led companies, contact me on LinkedIn. It's the exact opposite. So step one, profile your company. Step two, find companies that look and smell like your company in those terms. Are they serving a similar market? Are they at a similar stage? And then who invested in those companies and who were the partners that led those investments? S&P Cap IQ here, I'm highlighting, actually has a whole module called Find Buyers and Investors. Seems like it'd be a pretty handy resource when you're doing this work. Let's see what it looks like. So you go in just like CB. You'll start with a series of filters with industry, subcategory, what stage you're at. Hey, we just profiled our company. We should already have this. Fantastic. Shouldn't be too hard to fill out. And then, what stage of capital are you looking for? So you can see here, we're starting with a population of 326,000 investors. And as you apply those filters, we narrow it down to 150. That's another reason this is iterative. 150 is an okay list to start with, and you'll go through that 150, and there'll be some good ones, there'll be some that don't make sense. You'll change your filters and you'll get a new batch and refine that a couple times. If you go through a search and you come out with 40 on the other end, your criteria are too tight. You got to open the aperture. If you end up with 4,000, you're probably not going to get through the list. So as a starting point, 150, 250, you're in a good range to find some leads. What you'll also start to find, so here's Jay Hirsch again in Break Trail Ventures. A lot of the names repeat. So investors like to invest with the same co-investors over and over and over again. They sit on boards together. They've been through tough times together. That's when you find out what type of people you're co-invested with. It's easy to get along when everything's going well. Things don't always go well. So as you actually get to know another investment firm, and it's nice to have other pockets around the table, investors will tend to co-invest with the same investors over and over again. It's part of the network. It's how they win favor with each other, by sending each other good referrals. So that's a big reason why in the hierarchy of introductions, an intro from another co-investor is about as good as it gets. So you will see the same names repeated over and over and over again. I've broken this out, though. In the left column, you can see by deal size. So again, you're looking at, okay, well, who's investing in companies that raise similar amounts to me? There's 5 million at the bottom. You have 50 million at the top. The $50 million investors are not co-investing with the ones at the bottom, and vice versa. MarketLine is one of my favorite resources that we covered here. In large part because after you find a deal that you like, and you're like, man, this is an exact match for my company. This is a great fit. And I do recommend you find a couple. and each deal has a reference number. There's a button at the bottom of the MarketLine page that says Ask an Analyst. And you can put in that little Ask an Analyst box. Please do a search to find other comparable transactions that match deal reference 1, 2, and 3. And then email me that table of comps. That email goes to a bright young post-MBA in a basement in Chicago, who's then going to do this exact same work that we're doing here. It takes about a week for him to turn around, and is then going to email it to you. So while you're doing this work, you just doubled your labor ratio, and now you have an outsourced resource in Chicago doing the work for you. So that's one of the fun things about MarketLine. Don't forget about the Ask an Analyst button and get someone else doing some of this legwork for you. Similar examples here. This is another Carnegie Mellon company focused on strokes, and you're able to see the investors that come out of it: Pittsburgh Life Science Greenhouse and Carnegie Mellon and Alpha Lab Gear locally, which would be your intro routes to Elevate, and Goose has a couple investments here in Pittsburgh. Also, one investor on here that maybe we'll focus on is Monozukuru Ventures. So these are the guys behind Forest, CMU guys. They raised a $6 million round. And hey, one of their investors is a Carnegie Mellon alum. So don't forget about the alumni network. 99 Tartans is also launched. That's a alumni investment syndicate. Our friend here is active in it. He's upfront about what he likes to invest in. He has 37 portfolio companies, pretty active investor. You can get to him through LinkedIn, or we just covered, you have 5 other routes through local investment firms and Carnegie Mellon and the Swartz Center to get this intro. So other routes, and who does he most often co-invest with? So all of this is readily available to you in the resources that we talked about. So at this point, you've profiled your company, you found comparable companies, you found the investors who invested in those companies and the other investments they've made and who they like to co-invest with. Now you need to make contact. We've talked about mapping your network and, hey, who can make these introductions? You have incredible resource here at Carnegie Mellon and other Pittsburgh resources. So let's talk about those intros. We've established that a warm intro from another investor is as good as it gets. And hey, it is real. If you're not a fit, someone's going to tell you that you're not a fit, and be genuine about it. There is a way to test how genuine they are, though. Every conversation you have, I highly recommend that you ask for 2 introductions to come out of it. So if someone says, hey, I love your company, it's just not a fit for me, you're not at the right stage, I focus on a different market, but I really like what you're doing. Ask for 2 introductions. If they really do think that you're a good company, they should be happy to make introductions to other co-investors that they think would like it. That's how investors win currency with each other, by sharing deal flow. If they're not willing to make an intro, that's your signal that they were being polite. But get a multiple on your outreach efforts and ask for introductions from everyone that you talk to. There is a hierarchy of introductions, co-investors being at the top. Other investors who haven't co-invested but are still credible, not quite as good, but still pretty good. Investors, trust the judgment, at least to some degree, of other investors. And if they say, hey, I looked at this company, I think it'd be interesting to you, there's some credence in that. Your existing investors absolutely should be participating in this. So I like to pause there for just a second to talk about the role of the board and your existing investors. Your board, people say strategic advice, that's what we're looking for. That's great. Governance is important, not to be overlooked, but your board should be bringing money to the table. That's a bigger reason they're on your board. That's why you let them on your board. they should be cutting checks, but they should also bring other money to the table. So if your board is not participating in the fundraising process and bringing investors to the table who are going to write checks, you really need to think about whether they should be on your board. At the bottom of the list, but still incredibly important, is cold outreach. And then below cold outreach are investment bankers. So why do people hire investment bankers, and what do investment bankers do? I often get approached by MBA students and say, "Man, I'm interested in investment banking." And I said, "That's great. What is it you think investment bankers do?" I hear things about finance and strategy, and we do that. But then I also ask, hey, how do you feel about making calls? I said, "Well, what does making calls have to do with investment banking?" I said, "We are a sales and marketing organization. That's what M&A investment bankers are. We manage the deal, and we manage the negotiations, and we close, absolutely. But the reason people bring us in is to bring investors to the table and market their company for highest and best value." At the lowest end, an investment banker is taking labor that the CEO really should be spending running the company, making those calls, giving the pitch. Any client, I generally end up giving 250, 350 pitches on their behalf, selling, and that's half an hour each time. That's, at the bare minimum, what your investment banker should be doing. At best, what you're looking for is people who have real, actual personal relationships with the investors you're going out to, understand their preferences, the deals they came in second on, what they're hungry for, where they've been burned, and can get you in and get a real receptive audience. So if you ever are talking to an investment banker, you want to know, hey, have you worked with companies like mine? What's your relationship with the investors that I'm seeking to go out to? How well do you know them? And how well can you position me and get an audience with them? But at the bottom end of the stack, a lot of that legwork can be done by the people in this room. Cold outreach and persistence. Over time, if you start reaching out, say once a quarter is a pretty good cadence there. By the time it's actually ready for you to go ask for money, you won't be such a new name. So don't be worried to start this process before you're ready to ask for money, just to open up the communication channels and get introduced, make them aware of your company, put your company on their tracking sheet. You're going to get a big list of names, and you're going to want to manage those names. Larger firms are going to use a CRM like Salesforce.com. There's a bunch of free versions available online, but you're going to want to track the investors and all this information you've looked up. And you can do this on a spreadsheet. So if you're intimidated by signing up for a CRM, we'll cover what exactly do you need to keep track of so that you can manage your outreach. This is one of the other slides I'd recommend you take a picture of, and Allison at the Swartz Center will have these slides available, but each one of these bullets is a column that you should have in your spreadsheet. So as you're going through the databases that we just covered and you're filling out information about the investors that you're going to approach, this is what you want to put in your spreadsheet. Alternatively, it would be the fields in your CRM. So take a picture of that. And this is now your investor database. All right. So you've built out your database, you have investors, not just the firms, but also the actual person that you're trying to get a hold of. You've built out your database. Maybe you've been sending some intro emails, getting on some intro calls, asking your intermediaries to make those intros. And now it's time to actually make the ask. So what do you have to do to be prepared to make the ask? A quick fundraising process is a successful fundraising process. And it generally takes early stage startups 9 months or a year to close an investment round. So as you're burning cash, and I'm presuming that you're burning cash, think a year out at least as to, hey, when do I need to close on additional funding to keep my company liquid and in a good spot? And you should begin the fundraising process a year ahead of that. But once you go out to market, once you start having these conversations, you want to be prepared to run fast. Last thing you want is for an investor to say, hey, I'm interested, I'm excited, let's go. And then for you to have to respond and say, hey, wait, let me get organized. So I'm actually prepared to engage in this discussion. So let's talk about what you need to go to market. You have your investor list, a personalized introduction letter. So everyone you reach out to, again, going back to their profile and what their criteria are, reference, hey, this is where I found you. This is who we have in common. This is how I match your criteria. Greatly increases your chances that they're going to respond to you. And it shows that you've done a little bit of work. You're asking them to do work and reviewing your profile. Show them that you did a little bit of work to review theirs. A teaser is a one-page summary of your company and the money that you're raising. This is a document that you should prepare. You should not put anything confidential on the teaser. Fully expect that it's going to float around every corner of the world, but put on your core metrics, summary of what your company does, maybe some customer information, and a brief overview of the raise, how much money you're looking for and what it's to be used for. That's what the investor is going to look at to say, hey, does this match my criteria? If you get a response for that and they say, hey, I'm ready to jump on a call, that'd be great. Thanks for reaching out. I want to learn more. Have a pitch deck prepared. There's a gazillion examples of pitch decks on the internet. It doesn't need to be more than 20 slides. Any more than that, you're probably not going to get through it in a call anyhow. This is more detailed. You're given your full pitch to the investor. You want to have this prepared for that first introductory call. And then if that goes well, they're going to say, all right, well, like what materials do you have prepared for me that I can evaluate? I'm excited. Let's dig in. Two things. So one is a business plan or an information memorandum, but some packet that provides, really more detailed information about the company and your operations, your market, what you're going after. At this point, you should probably be signing an NDA, depending on the investor. But I'd say most venture investors don't sign NDAs. They look at too many deals. They can't administer them. So if you're with a strategic, maybe appropriate, but generally speaking, most venture investors are not going to sign NDAs. So just be careful about what level of detail you share. It's really on you at that point. And then assemble early diligence documents. These will be your legal documents, your financial documents, any IP documents. Have those prepared. And there's lists available on AngelList, et cetera, that will tell you everything you want to have prepared for a first round of diligence. But again, the point is you've done all this work to find the people and engage the people that you want to talk to. Once you get them in, once you get excitement, once you get a little competition, so, hey, I'm talking to multiple investors, I can only spend so much time with you. You want to be prepared so you have momentum and you can go fast and not have to say, hey, why don't we pause this discussion, let it cool off a little bit while I go get prepared. That's the process. I'd like to take a little pause there and field some questions. If has anyone been through a fundraising process before or been part of a company that did a fundraise?
I work for a company which is funded by Axel in India. So they raised money from Axel, but after that they couldn't really get much traction. So they were finding it very hard to raise a second Series A capital.
Yeah.
In spite of raising money from Axel. So I think the problem there was they raised money before building a prototype. because the founders, I think one of the founders worked at Axel before.
Mhm.
So he used the network to raise money, but after that they couldn't really find product. So they found it very hard to raise money.
Yeah, so that's an interesting dilemma. So you're part of a company that raised seed funding from an incredibly credible, well-known investor, but got a little bit out ahead of the skis and wasn't able to develop the product or hit the performance metrics to get the subsequent funding.
I think the founders have been trying for the last 1 year.
Yeah. So you're highlighting an interesting dynamic that happens and kind of ties back to a comment I made earlier about however much money you think you want to raise, you should probably double it. I get asked all the time, Ben, do people give away or do they sell too much equity too early on? Absolutely, 100%. If you think the value of your company is going to go up, you want to sell as little equity as possible. The flip side of that same coin is, Ben, do you see people who don't raise enough money? 100% all the time. So this is one of the examples where I speak out of both sides of my mouth and I say, don't sell too much equity too early, raise more equity than you think you need. And my honest advice, 9 out of 10 times, take the money. If they're the right investor and you're going to grow the value of your company, owning less of a bigger pie is usually the right way to work out. So the trap that your company's fallen into, over the past year, the CEO, COO, CFO, they've been working on fundraising. That means they're spending less time running the company, which means they're not hitting the performance targets that they would need to do a successful fundraise. Happens all the time. You raise just enough money to get through, I don't know, 18 months. It wasn't enough time to really post performance metrics, customer acquisition, advancement with the product and technology to go out and do a successful subsequent fundraise. That's why you see bridge rounds. That's why you see down rounds. So that's really a big reason to raise more than you think you need. Buy yourself some cushion, because you also want to go into these negotiations with some cash on the balance sheet so that it's not do or die. And they know, hey, if they don't take my money, this company's going to fold. So that's a really important example and a spot, unfortunately, a lot of companies find themselves in.
And one of the co-founders company, so that was a huge blow for the other founders because every time they went to an investor, the first question was why did the other
do you have any insight as to how Excel helped out in this process?
Not sure because the founders didn't share.
Yeah.
The thing is, they raise money just with the notion pitch deck. They didn't have any product before raising money because one of the co-founders worked for Axel before that. So they were able to, and I think all the founders had like previous companies, so they were able to raise money just with their credentials for the product and stuff. But like they raised $2 million, but after that they didn't.
Yeah. So other dynamic that you're highlighting, this is true for investors as well. Big name brand investment firm makes an investment. Like, wow, I should follow that investment. Those are big fancy guys. Kleiner Perkins came in. Oh my gosh, I should follow what they do. Big firm, little investment, not really a strong signal that they're committing resources. It's kind of like placing a chip. They'll come back later and see how it's doing to see if they want to put a meaningful investment in. So as you're soliciting investments, there's a lot of value in a name brand, particularly as it goes to putting together a syndicate of investors. So other investors who are going to follow along, and you want to get your lead first, if possible. What you'll hear a lot when you're out raising money is, hey, I'd be glad to cut a check once someone else cuts a check. And you're going to build up an inventory of people who say that while you're looking for your lead. The appropriate response to that is, great. Let's pause our conversations. I'm focused on finding a lead, matching up with the right lead. Once I have that, we'll come back as we're putting together the syndicate. We can tell you how much is left, if any, for you to participate in. But big investment firm, small investment, doesn't necessarily mean that you're going to get access to the resources that firm has to offer. And depending on your company and what your expected capital needs are, you might be better served with a smaller local fund where you're going to get more actual attention from the partners and the investment managers who are going to work with you and be willing to invest their own time in making introductions to bring other investors in because they have meaningful skin in the game.
Wondering if you could walk through some of those strategic considerations when evaluating follow-on investors. So obviously you don't just want investment from anyone, right? But as and of course this is context dependent, but as you know, a founder or someone that's kind of supporting the fundraising process, what other considerations might you look at?
Yeah, and do you have any context in mind you want me to kind of tailor to? Just in general? Yeah. So honestly, one that I would start with is reputation. I've been fortunate through my career to have good mentors, and the best advice that I always get is who to not co-invest with. Everyone can tell you who to invest with. Investing in a company or taking investment from an investor is a little bit like getting married. You're going to be together for a long time. And just like any business or any relationship, there's people who don't play well with others. There's people that are not constructive, who will not cut checks when things are tough or did not plan ahead for that, did not reserve follow-on capital for it, or who have a bad reputation in the investor community. And will scare away quality investors. I've passed on deals because of who was already on the board. Thought the company was great. Board member had a bad reputation. I've been told, do not co-invest with this firm, this person. And I passed. Happens all the time. So reputation's important. They're going to check your references. You should have no qualms of asking for references from other co-investors, which is easy. It's, you're asking for introductions anyway. If they have hesitancy, take that as a sign, but then also their portfolio companies. Experience with companies at the same stage as yours. So a big consideration is, hey, have you done this before? I don't want to have to learn, I call it paying tuition. I don't want to have to pay all the tuition myself. I'd like to learn from things you or other companies have gone through, that you have gone through personally. Maybe they've sold a company. That's how a lot of investors become investors. So do you actually have experience selling into my markets and with companies at my stage? Companies have similar growing pains when they go from 0 to 10 million or 10 million to 30 million and above. So an investor who's been through that, that's important for you to look for. Some are career financial investors, others are former operators. Do they have an operator bench, often called operating partners, that they can pull in? Who will you actually be working with on a day-to-day basis, and do you have a good personality fit? From a financial perspective, look at how old the fund is. Funds typically have a 10-year life, and around year 12, the limited partners who gave those investors capital are going to start wanting their money back. Sometimes, not all the time, but sometimes when you see a deal announcement and the financials of the deal look a little quirky and you trace it back, it's because the investors were in year 12 of a 10-year fund and they were pushing for a deal that maybe wasn't optimal because they were under pressure to return capital. So it's one thing to have a fund. How much dry powder do you have? How much do you typically reserve for follow-on investments? And how many years into the fund life cycle are you? Is this your first fund? Is it your third fund? Do you invest across funds? As an LP, I don't particularly like it when investors invest across funds. It can sometimes prop up returns of an old fund with proceeds from a new fund. But then there's firms like Bain, who specifically have dedicated funds to invest across a company life cycle, and they can grow companies funded entirely from their own funds as they mature. And that's appropriate. So do you have multiple vehicles? And then the co-investors, and who have you exited to? Have you been through that process? And can you make introductions to my potential customers as well? At the end of the day, capital can come in the forms of revenue, equity and debt. Revenue is the cheapest and best. So can they help make those introductions as well? But probably the one I would highlight the most is reputation. Get some referrals. In these conversations, it's really difficult to keep the perspective that we kind of exalt investors. We put them up on a pedestal. These are incredibly bright, successful people. I mean, certainly successful, sometimes bright. It can be difficult to keep that perspective, but these are just people too, and you're going to have to work with them. And when things get a little tough, that's when you really find out who you've partnered with. So I really can't stress enough, check references, spend a little bit of face time with the people and make sure that you have a personality fit as well. Oh.
Online question.
Okay.
Since it generally takes 9 months to 1 year to complete the fundraising round, I just wondered what is the prospect of raising capital this year?
If you are starting now, you can close a fundraise in 2023. So our process is at 7 Mile. We benchmark it every year. It takes 6 or 7 months from start to finish. If you are starting the process now and you're just starting to put together your investor list or just starting to collect your materials, you could still close a deal in 2023. But I'd start hustling now. Once you get into the summer, you're really looking at the next year. And often we'll be approached by companies in Q3. So think August, probably the latest, who would still like to get a deal done that year. And at that point, the compromise that you're making is you're going out to less investors, you're getting less shots on goal, less of an opportunity that you'll get someone who will come in over the top with a above market valuation and better than market terms. And you really, really, really have to have all your ducks in a row from a diligence standpoint already. So do you have an attorney that you're working with, both corporate and deal counsel? They should be different. Your deal counsel should be a specialist that only does transactions. You don't want to use general corporate counsel to do a deal. Do you use an outside accounting firm, or you're in, are your financials all buttoned up? And everyone always overestimates how buttoned up their financials and diligence documents are. Even the private equity owned companies are never as clean as they think they are. So you get into the summer, it's probably a little too late, but if you started working now, you can definitely close a deal in 2023. I was going to ask the investors in the back row, we got the question about strategic considerations when picking an investor. How would you guys answer that? Or what do you look for when you're deciding, from a strategic level, not your investment criteria, but what do you look for to say, hey, this is going to be a good match, someone that we want to work with and we expect to be a successful partnership long-term?
Well, I would say similar to how you said you're not picking an investment firm, you're picking an investor. I would say the same thing. We're looking at people that, the company, we see the great ideas all the time. It's really about, the person running that company. Are they going to be able to steward this through all the hurdles that are going to be in front of them? How's the relationship? Because like you said, it is a two-way relationship. So do we enjoy working with that person? Are they someone that's coachable? So yeah, those are all things that I kind of look for.
I was just going to also add that when we get potential startups to invest in, we get a lot of them. It seems like a lot, and we're very busy. And so I pretty much expect you'll send me your pitch deck before I talk to you, so that I can see if you're worth talking to. If it's not perfect, like if there's spelling mistakes or sloppiness in it, I'm pretty much asking on it, because it seems like you didn't put your best foot forward right off the top.
Yeah.
So just some experience sharing for how I'm, that first touch, I think is really important to put your best foot forward.
And it's hard to redo first impressions.
Yeah.
Yeah, absolutely. Any war stories you want to share of either comical or otherwise?
Jen also did due diligence.
I don't want to disparage.
No names, no names.
No, I mean, we've just seen some ideas that were obscure, to say that. But I guess as someone who kind of does a lot of direct due diligence in companies, we're trying to answer 3 questions, and that's why you, why this, and why now. And those things kind of have to make sense from an operational due diligence standpoint. And I like your slide there to talk about the deck being about 20 pages or less or so. We get a lot of decks that are extremely lengthy, extremely wordy, and it's hard to sift through a lot of information. So I would say put the most pertinent, valuable information you want us to know first forward, and then we can always dive deeper in your data center and so on again.
I like that you highlighted why now. You should answer, this part of the self-reflection, but you're also going to get the question, why are you raising capital? And a good part of that answer is that there's an urgent market opportunity. If you bootstrap and you go a little slower, someone else is going to capture it. That's a good reason. Otherwise, going back to preserving equity, maybe it would be better for you financially to take it a little slower, preserve more of your ownership if you can still capture that opportunity a few years later. So it's important to reflect, why exactly am I raising this capital? What am I really looking for other than dollars? Because what is it that I'm trying to achieve? How am I going to invest that money?
Yeah, that use of capital is huge. Your burn rate, what you're going to do with it, does it actually make sense from a strategic standpoint, and so on and so forth, and your projections, your performance statements, and so on, those all have to align. And also, if you've already raised capital, your cap table has to make sense too. So we've looked at businesses where we look at certain things such as that. We like the idea, we like the founder, but then when it comes into the dynamics, we have to pass on it.
Mm-hmm. Any other questions?
So, slight deviation, but I was wondering if how this process might differ for investors that are seeking out new LPs. So I know that's mostly relationship based, and not easily found through secondary research. But if they were looking for new LPs, how many?
Yeah, so a lot of the same databases also have modules for identifying LPs, and that information often gets disclosed because some of the LPs will be like public endowments that have disclosure requirements. So the local foundations, as an example, it's not easy, but it's fairly easy to look up all the funds that they're invested in. Similar process. There's also bankers who focus on fundraising for funds. So while I mostly do M&A transactions for companies, other capital markets bankers do fundraising for funds. So similar process, often also going through intermediary financial managers who manage endowments on behalf of those LPs. They'll often do fund selection. So a firm, I sit on endowment. The manager we use locally is Bilky Katz. They sit down and interview the fund managers twice a year. And then when we're evaluating new funds, we really filter everything through them before the investment committee will even really sit down and look at the offering memorandum. So it's a similar process, but there's maybe a little more use of intermediaries because you're almost by definition now at an institutional level where you're going to have professional management at each layer. The materials, though, largely are going to go back to your prior fund performance. So, there are some jokes that will go around. Is it best to, raise your second fund before your first fund's out of the gate? Because, hey, if you're still investing, it's hard to evaluate your performance. And if you had a poor performing fund, it's going to be difficult raising that next fund. And you'll see the length of time it takes to raise a fund highly correlated to prior returns. So if you're doing well, fundraising's easy, and will move quickly. You'll be oversubscribed. If you're having a harder time, it'll stretch on. Saw an interesting dynamic recently with a fund. Prior fund had pretty middling performance when they went out to do a fundraise. They were in market for, I'd say 2 years. And by the time they were kind of winding things up, they had a couple huge exits that really popped the performance of the prior fund, but the timing didn't really line up. So timing is difficult. Companies don't always follow the plan you put on a slide, and that doesn't always line up with your own fundraising needs. I know I've belabored this point, but I'm going to hit it one more time as a little bit of my own plug. So I take interns from Carnegie Mellon every summer. This is a lot of the work that those interns do. We also flip it around, company prospecting. So when you're an investor and you're looking for companies to invest in, or you're an investment banker looking for clients, very similar process, just flipped around. So if any of this work is interesting to you, again, we mostly deal with tech companies. That's my email. Connect with me on LinkedIn, shoot me an email. Always happy to grab a coffee, but I recruit interns out of Carnegie Mellon every year, often coming out of this talk. And if this work is interesting, and you're interested in seeing what some investment banking experience looks like, if it's the right fit for you, please shoot me an email. But again, every single company in the Swartz Center, every one of the McGinnis companies that are going to turn into highly successful real startups, they all are going to need this help. And it doesn't take any specialized expertise. It takes a little bit of logic. It takes some time and some persistence and organizational capabilities. But all companies need this help. So if you'd like to get involved with a startup and you're wondering, what can I do that's really value add? This type of work would be welcome on any team.